Thanks for listening to our webinar on how to get ready for your next audit. This is specifically for our not-for-profit organizations, animal welfare and conservation. We hope you can take away a few good tips today to improve your next audit experience. I'm Grace Williams. I'm a senior audit manager out of our San Francisco office. I specialize in not-for-profit audits. I also am part of our animal welfare and conservation sub-niche. I've been with Armanino for 11 years.
Hi, this is Jessica Summers. I'm a senior manager in our San Ramon office. I've been in public accounting for 7 years and worked primarily with not-for-profit organizations, specifically animal and welfare clients.
Hi, this is Melody Zhu. I'm a senior tax associate in our non-for-profit tax team, and also I'm a member of the animal welfare and conservation sub-niche.
So what we kind of wanted to run through first is just really the 3 main takeaways for how to improve an audit. So as auditors, we really want the audit to be the most efficient and effective process. You know, nobody likes surprises, and the best way to minimize those is really just to work with your auditors often. So how do you do this? The first way would be through communication. You should communicate early and often throughout the year if any challenges are coming up. You know, as finance people, you guys are good with the day-to-day operations. What really causes issues are those complex situations that may come up. So really just disclose everything. It's better to know about any potential issues in advance than for your auditor to find them during the audit. And then if you don't know what to do about a transaction, so maybe it's a situation that's new or you haven't been exposed to it in a few years, talk through those with your auditor just so there aren't those surprises. And then lastly, work through that PBC list with your auditors. If you're not sure what the term PBC stands for in the accounting world, this is either prepared by client or provided by client. This is your schedule request that the team receives and will send to you at the beginning of the audit with all those requested documents. So go through this list with your auditors, talk through any confusing requested items, you know, work through that list, make sure you're on the same page before the audit begins. Oftentimes we find that clients might not have provided us some schedules just because they weren't sure really what the requested item was. And then also we don't want you having to create schedules just for the audit. If we can leverage the work that you do on a day-to-day basis, that's really what we want to do. There may be situations that come up where our schedule request has it named something differently, or the description might not be very clear. But this could be something that you do on your day-to-day basis that accomplishes the same thing that we want. So don't try and recreate the wheel and create a schedule just for the audit. Really talk through any of those items with your auditor before you go through that process.
I think really what the takeaway on this slide is that we want this to be a collaborative relationship, right? As your auditors, like, we are here to help. So please reach out, communicate often. That's really going to lead to a successful audit.
And so really, if you have those 3 things on the main slide, you know, what else can you use your auditor for? How else can your auditor help you? And so we can work with you to validate the things, you know, you do really well. But the other piece of that is we can be a change agent for you. So change is hard. You know, sometimes there might be a new system you want implemented or something that you know you need to change, you know how you need to do it, but you just need someone else to help say it. You know, if you've been saying it, it might fall on deaf ears, but if your auditor comes in and makes the same recommendation, kind of says the same thing, everybody kind of hops on board. So work with your auditor for this. You can leverage them to be able to get, you know, your needs fulfilled. Also work with your auditor for any, you know, internal controls or best practice recommendations. Your auditors work with many different not-for-profit clients, and you might find yourself in a situation where maybe you're the only person left in the finance department, you're running everything, or everything's kind of falling just on you. You find yourself doing everything. In that case, you know, look to your auditors for what a recommendation might be. How do other organizations in a similar situation as you, how do they segregate duties? Or maybe how do they have internal controls with having such limited resources? So asking your auditors those types of questions and, you know, leveraging their experience with organizations that are in similar situations can really help you. And, you know, maybe the recommendation in that case wouldn't be to hire somebody else, but it would be to, you know, get someone else involved in the process. So maybe someone from a finance committee or a board to provide additional oversight and really help strengthen your internal controls.
And we touched upon this on the last slide as well, but discussing transactions in real time. Super key to a successful audit. We don't want to know about, you know, significant issues at the start of our audit. We'd rather you contact us, you know, when you're experiencing those issues so we can work through them together. You know, we're always available for a phone call. You know, send us a difficult bequest or grant agreement, and we can give, you know, the proper advice and work through it together before it's recorded. That way, that when we come out to audit the transaction, we already know that it's recorded properly, and that will prevent any audit entries.
And then the last piece on here is just kind of technology. So most organizations we go out to, there's some sort of technological frustration. Maybe they aren't getting the right reports or they don't have the right systems in place. So this is something you should talk to your auditors about. You know, as auditors, we see lots of different systems and technologies, and we can give you some best practice recommendations of what other organizations that are in a similar size or nature are using or doing to combat these frustrations. A lot of organizations we run into that are frustrated may not necessarily be with the technology piece, but would be with all the manual processes and workarounds that they have to do. You know, as software continues to get better and better, there are a lot of ways an organization can automate those processes. There may be some functionalities within your current system that you could implement that could save countless hours each week. So something you should do is just talk to your auditor about this. You know, maybe ask the question, how can we better use our current software to better automate all these processes? And then there's also systems out there. So if you find that your current system, there's no more functionalities that you could use for it, maybe you need some help with a monthly close or a financial close process, you could look into a system like Blackline, and it could be where the cost of implementing the system may be worth the time saved from having to do everything manually. And then lastly, cybersecurity is always a huge issue among all organizations and companies. The big thing for not-for-profits really isn't the financial loss that you could incur. It's really the public perception and the donor's perception of an organization after a breach has occurred. So really getting in front of all of those issues and having a data readiness test done to ensure that you have proper safeguards in place will really help, you know, better your organization and let your organization kind of grow. And so what we kind of wanted to do now is just jump through each of the different areas of an audit, walk through common issues that we find, and really kind of help you out as much as possible to kind of set you guys up for success for your next audit. And so the first one, cash and cash equivalents. So the real main thing with cash is really completeness. Everyone can audit a cash account. Anyone can do a bank reconciliation from what they know and what they can see. The issue is what you don't know. So if there's any cash accounts that maybe are being missed on the general ledger or weren't picked up in the listing that was sent to us for the confirmation process, or, you know, transactions on the bank reconciliation that aren't being picked up. So just make sure that as you go through your process that you maintain a complete listing of cash accounts or changes in cash accounts during the year to prevent any of these issues. The other things on here are just kind of minor, really just reclass type things. So depending on your organization's cash policy, you may have some cash sitting in investment accounts that should be presented as cash on the statement of financial position. So just really making sure that any of those things have been properly reclassified before the audit begins. And then you also may have some restricted cash. So if you have any endowment funds, maybe it's restricted for land purchases or it's used for finance and collateral. So if you have to maintain any certain reserve amounts or keep those balances on hand. So just reclassifying those balances ahead of time. And if you aren't going to make the reclass entry yourself, just making sure that you've at least identified those amounts as restricted cash will really help and prevent any potential missed disclosures for the financial statements. And then so down here on the bottom is just kind of a best practice tip for you. So maintaining that listing of accounts with all the information relevant to it. And, you know, it really just touches on completeness. And how does maintaining that listing of all accounts and bank information help you? You know, how does this help your auditor? Well, your auditor most likely is going to be confirming cash at year end. And most banks nowadays are able to confirm cash electronically. So really, if you have this listing maintained throughout the year and updated, you're just able to send this off to your auditor and you'll be done with that process.
All right, the next topic we're going to talk about is investments. We have planned giving agreements listed here since these will be typically held in investment funds, especially if you have like a charitable remainder trust or a pooled income fund. Those are, you know, typically held in an investment fund, and the fair value measurement disclosures will apply to those. So anytime you see, you know, the word will or trust or bequest included in any of the donor agreements that you receive, that should be a triggering event to come talk to your auditors. You know, these transactions can be difficult to record depending on, you know, whether there's multiple beneficiaries or whether it's, you know, revocable or irrevocable. So it's important that your auditors are aware of these transactions. Even if you're aware that there's a large gift coming in, it might not need to be recorded for, you know, your current audit. But maybe it needs to be disclosed in the financial statements. So just making sure that your auditor is aware of, you know, any of those significant planned giving agreements. Also, we are starting to see more alternative investments these days and other level 3 types of investments. And with investments, you know, it all comes down to valuation. So it's easy to, you know, value a mutual fund and easy to record that value on any given day. But, you know, an investment in a private company or maybe investment in real estate, certainly those types of investment vehicles are more difficult to value. So discuss those, you know, discuss with your auditor to look what type of information is available and what type of information your auditor is going to want as part of their audit. And so that way, you know, you can appropriately value those types of instruments. What we really want to know is what you're doing to get comfortable with the value of those investments recorded on your books. I guess one of the best practice tips that, you know, is very important is to be performing that monthly roll forward of your investments. Your auditor is going to want to see all of that activity for the year between the beginning of the year and end of the year, and it's going to be much easier for you to accumulate that information if you're performing that roll forward on the monthly basis than trying to, you know, go through the investment statements, you know, month by month at just the end of the year as you're preparing for the audit. The other thing you might want to consider doing is considering the leveling inputs of your investments. So, you know, detailing out each of your investments by level, whether that be level 1, level 2, or level 3. This is something that's going to be needed for your financial statement footnote disclosures. So, you know, be good to prep that ahead of time.
So contributions, receivables, and bequests, you know, typically this can be a real tricky area. So it is an area where we do see a lot of adjusting journal entries, particularly if there's a capital campaign or if you've received a challenge or a matching grant or some other type of conditional contribution. This is one of the more complicated areas since it's definitely different than what we usually see. You know, these are non-reciprocal transactions. So a donor is pledging an amount and not getting a good or service in return. The way that GAAP accounts for this is you would record that promise to give when it's made, so not when the cash is coming in or when it's being paid. And the cash can come in years after this, so it can be kind of unusual feeling to record it or, you know, just to understand how it works. And we do end up seeing a lot of issues here. So some good questions to kind of ask as you're going through this process is, you know, is it a valid pledge? Should it even be recorded? Are there conditions attached to it? You know, making sure any language in the agreements are properly recorded with what the donor intent is. If you find yourself having any matching conditions that may not be met, you know, trying to figure out when it should be recorded. And then anytime that there is more complicated language, that's really when you want to spend more time to kind of understand what the donor's intent is and what the accounting behind it should be. With capital campaigns, we do see some language where you could be building, a building or maybe a new shelter, and the agreement could state that 90% of contributions come in would go towards this new shelter and the other 10% would go towards an endowment. Well, the question can be asked, what 10%? If you talk to the people that are running the shelter project, they're obviously going to say the first 90% is going to go towards the shelter because they want to make sure that they have the funds available to finish the project. But then some could argue that the other 10% should be split. So as in 10% of every contribution that comes in would have to go towards the endowment, not the last 10%. So just making sure you're kind of looking at these things and that everyone's interpreting it the same and you're all on the same board for how it could be recorded, so you're not recording it incorrectly. And then if you do have any development departments, making sure that you're meeting with them and that you guys are all on the same page and everything's valued and being recorded correctly. Oftentimes development knows about something that may have come in that the finance department doesn't. And then talk to them about allowances and collectability. So there could be something that they know might not be collectible and they just haven't relayed that information yet. Collectability is a big thing that, the auditors come in, they're going to have questions on the collectability of some of those contributions. So just making sure that you've looked over your listing of receivables and that you've identified if there is anything that should be reserved for or written off. And then if you do have any multi-year contributions, making sure that you've kind of looked at when they're going to come in, so when you expect those future cash receipts, and then considering whether or not that you need to discount that back to net present value. Those are another area where there could be an audit adjustment if you haven't already done this calculation or even considered the calculation. And Grace, do you want to kind of walk us through some bequests?
Yeah, so on bequests, these can be quite significant. And we touched briefly on it on the last slide, but they can also be difficult to record since, the related will doesn't become irrevocable until the donor's death. And so sometimes the organization will not, exactly know when that occurs. But then in addition, the estate also needs to go through probate in order for the organization to know the value of the gift that they're going to receive. So sometimes these bequests can be really difficult to determine when to record that receivable. So it's important that the organization develops a bequest policy, that dictates when you're going to be recording those bequests. And then this would be also another good example of where to discuss with your auditor. If you receive a bequest and you're not sure whether to record it, we would certainly love to hear from you at that time and we can work through it together.
Yeah, and so down on the bottom here, we just kind of had our best practice tips. So really the main thing was just make sure you have a schedule that ties to the general ledger and notes kind of what those purpose restrictions are, and then when you expect to collect the funds.
And Jessica touched upon it a little bit earlier as well, but a lot of adjustments do come up, with respects to contributions receivable due to a lack of communication between the development department and finance. So, a lot of times those contributions are going to come directly to the development team, and for whatever reason, it doesn't get to finance timely. So ensuring there's ongoing communication between development and finance is key, especially, near year end where the cutoff could be an issue. So best practice, perform that reconciliation between development and the general ledger at least quarterly. When you perform this reconciliation, it'll also, make sure that that ongoing communication is being performed throughout the year.
So then kind of looking through fixed assets, fixed assets are fairly easy, the day-to-day things. So being able to record a purchase of a computer or furniture really isn't going to be an issue. What we do find as difficult and where we usually find issues is when there's construction going on. So some common areas would be not recording all the payables related to that construction at year end. Oftentimes we see that those invoices from contractors don't come in for a month or two or whatever it may be. So there's times when we do come in to do the audit that last accrual may not have been recorded. Another piece that often gets missed is the retention. So retention is basically that last 10% on a construction that gets held back from the contractors to make sure that those final checklist items are complete and the project's actually getting done. So once that project's done, that 10% would be paid, but before that happens, that 10% that was held back should be recorded as a payable, and this gets missed a lot. Another tricky item with construction is usually the construction comes out of a campaign to build a new building or maybe a new shelter. And so this kind of ties in with our net assets. But if you raised donor money for all of this, all that money should have been recorded as restricted. And throughout this whole building phase, you're remitting cash, you're paying your contractors. But really, you need to stop and ask yourself, when do those restrictions get released? So when does those donor restrictions, when has the restriction been met? So what GAP says is that those restrictions are not met until the building is placed into service. So really looking at that and making sure you're not releasing those funds until the building is done and placed into service is important. Oftentimes we do have adjusting entries to correct that as well.
All right, this next topic is really going to be geared towards our land conservation organizations, but very important because some of these land transactions can get a little complicated, and they're typically quite material, so it's important that the proper documentation is being maintained to support the amounts that are being recorded. So something your auditors will always ask for when testing land acquisitions is going to be the purchase agreement in the case that the property was purchased. Or if you received a donation, you'll need to provide the deed of trust as well as the current appraisal of the donated land. The land transactions or the land acquisitions are typically recorded at cost in the case where the land was purchased, or if the land was donated, it needs to be recorded at fair value. So just important to make sure you have those, the proper documents on hand because the auditor will request for those items. Conservation easements, the agreements that put the restrictions and limitations on land, these can get tricky sometimes, especially because sometimes when the easement is purchased, the amount could be a significant amount of money. And so, based off of the GAP rules, since the organization doesn't necessarily have title to the properties for which the easements relate, and since there's no expected future economic benefit, the easements don't get capitalized. So based off of those rules, the purchase easements are expensed when they are required, and then the donated easements are not recorded at all. Even though you don't record those donated easements, it's still equally important that you track those appropriately and you have those listed in your listing of land and easements. For any divestitures or transfers of land easements that occurred during the year, your auditor is certainly going to want to test those transactions as well. So just making sure you maintain any of those transfer agreements, as well as maintaining the deed of trust, showing the transfer to the other entity. And then last on this slide, but certainly a significant audit area, is evaluating any land assets for impairment. This was certainly something that came up for several of my clients this past year with the devastating fire season in the North Bay. Unfortunately, some of the properties for some of my clients were damaged, and management then had to evaluate for impairment of those properties or write-off in the case where there had been land improvement or been improvements on those properties. So just make sure that you're considering any impairment as you're going through your year-end close and performing the valuation before your audit team comes out. And then when it comes to best practice tips, I think the most important thing here is just, since your auditor is going to be testing all that activity and any significant activity for the year, just make sure you have a complete and accurate roll forward of those land conservation and easement assets that you have. That way it'll be easy for your auditor to test that activity.
So accounts payable and accrued expenses is really a straightforward area, but there are some adjustments from time to time. The best practice is really just making sure you have a detail of all your accounts payable and accrued expenses that ties to your general ledger. As far as accounting, where we do see audit entries and adjustments is really accrued salaries and wages. So making sure if that year-end payroll was paid out in a subsequent period that you've accrued for it. And then the other one is accrued vacation or any PTO accruals. So making sure you have accrued for what's been earned but not paid out as of year end. And then that you have a schedule to show those balances and it ties back to the general ledger.
Then I think the only other thing I would say here is, while it is a straightforward area, we actually do propose quite a few adjustments here. And that's really just due to the timing of when you receive those invoices. So any subsequent invoices that come in that relate to the fiscal year under audit, you really need to make sure that those have been accrued for. And you should review for those accruals through, through the start of the audit. Because most of the time the audit adjustments that we do propose are preventable. Okay, so debt, this one seems like it's pretty straightforward because you have a balance that you owe and you record it. But there are some nuances here that we want to look at, especially with debt covenants. You certainly want to be monitoring those closely and performing the calculations regularly to make sure that you're in compliance. Also with some of the accounting changes coming, you want to make sure you're looking ahead to see what types of impact those might have on your covenants, and then talk through them with your banker. So for example, with the new lease accounting standards, in a couple years, you could potentially have a material asset and a material liability that gets recorded. So making sure you're looking at what that change could potentially do to your covenants, and then talking to your banker to see if there's possibly a need to make any modifications to the covenant requirements. I also want to stress how important it is to be performing these covenant calculations regularly. There's been instances when I've gone out to perform an audit, and something that we always do as part of our audit is making sure the organization's in compliance with those covenants. So in instances we've gone out to do the audit, and we run the covenant calculation, and it turns out that the organization was out of compliance. And it was something that they were not even aware of. And that ended up actually holding up the issuance of the financial statements, because then the organization had to go back to their banker, request a waiver. Took several months for that to occur. And then, we were able to eventually issue. But, a lot of times the bank will offer a waiver if you're out of compliance. Just certainly something better to have those conversations about real time. And if a waiver does need to be obtained, certainly try and get that process started prior to the start of the audit.
Grace makes a good point with the covenants. Another thing that actually should be considered that would affect it is if you're having any adjusting journal entries that come up as part of the audit, you would have to go back and recheck that covenant calculation just to make sure that none of those adjusting entries now put the organization out of compliance. So it's one of those areas where it's really important, and we can't stress enough just trying to have, make sure that you give yourself some leeway with them if you are starting to get close and you're worried an adjusting entry might push you into that failure, reaching out to your bank ahead of time just to start working on that process.
Yeah, that's a good point. And then the other item on debt that I wanted to touch on is just with regards to interest. There's several organizations that I work with that have debt agreements where there's either a 0% interest rate or maybe a below market rate interest. So just making sure that you're performing and considering any potential imputed interest that would need to be recorded. Also something to consider, if you are in the midst of any construction projects that you took debt out for, the interest on that debt can be capitalized into your CIP. So just make sure that you're looking out for that as well. For debt, one best practice tip that I'd say is, make sure you do provide all the debt agreements or, line of credit agreements. There's times where, potentially an organization will take out a line of credit, but since there's maybe they didn't take any draws during the year, so the balance is 0 at year end. So it won't show up in the GL, right? But that line of credit still needs to be disclosed in the financial statements. So certainly an area that could get missed if you're not disclosing those agreements or providing them to your auditor. All right, so net assets. Obviously this is a very key area to all nonprofit organizations in the area of higher audit risk. So what's key here is making sure that the donor contributions that have been received are being recorded in accordance with the donor's intent. So the first thing that your auditor is going to do is make sure that the beginning net asset balance rolls forward from the prior year. So meaning, does your beginning net assets agree to the prior year audited financial statements? And a lot of times if it doesn't agree, it's because, maybe there were some prior audit adjustments that didn't get posted. So it's a really good practice that you're performing this, beginning net asset check before the auditor gets out there. The area that your auditor is going to be most concerned about, though, is with respect to your restricted net assets. So make sure you're maintaining a complete and accurate roll forward of any restricted net assets. A roll forward that includes the addition to those restricted net assets or your current year contributions, and then the related releases from restrictions during the year. And something to mention here is that with the new nonprofit reporting model that's in effect for this year, even though the temporarily restricted and permanently restricted net assets have now been collapsed into one new category of net assets, now called your net assets with donor restrictions, just make sure you should still be maintaining separate schedules for tracking purposes, since you will still need to know your restricted net assets due to either the purpose or time restrictions, or versus the net assets that need to be held in perpetuity, which would be what we previously called your permanently restricted net assets. So it's just the verbiage of the categories that have changed, but the accounting for the restrictions has not been changed, and the amounts actually will still need to be disclosed in the financial statements. So continue keeping separate schedules for the different categories. The other item to mention on net assets is with regards to the tracking of any board or donor restricted endowment assets. An issue that commonly comes up is with endowments is the endowment allocation entries and the allocation of any investment earnings. So depending on whether you have a separate investment account to hold your endowment, or maybe they're commingled with non-endowment investment funds, you'll need to be making an investment allocation entry. So also making sure that the endowment appropriations has been made and is in accordance with the organization's spending policy. So these are entries that need to be made, and your auditor will always be happy if these adjustments for the endowment earnings and appropriations have been made prior to field work.
Kind of moving next into our statement of activities, running through some of the accounts. The first would be fee-for-service revenue. So this is the revenue earned from services provided. In the animal welfare space, this could be from adoptions, spay and neuter, any other medical services that the organization's providing. Typically, we don't see too many adjustments here, but just as a best practice, we would make sure that you have maintained schedules for each of those revenue streams that ties back to your general ledger. And also that you have the statistical information for each of those. So the number of adoptions that you had during the year, the cost per adoption, maybe the number of spay and neuters. So just the different services and the rates that are being charged for each of those. And then another thing just to mention, if you are going to use a different system, so if you have some point of sale systems that aren't automatically integrated into your general ledger, making sure that you have a schedule and it properly reconciles back.
All right, so contribution revenue. So we already touched on this topic quite a bit, but certainly, it's typically your highest risk area for nonprofit organizations, and will be an area of high scrutiny by your auditors. Also, we see quite a few adjustments in this area, primarily related to the classification between contributions with or without donor restrictions, and then also on the cutoff, making sure that those contributions are recorded in the correct period. So with restricted contributions, you want to note that these can only be restricted by a donor. And so you can have restrictions based on a specified purpose, or maybe it's a program that they're trying to support, but there also could be a time restriction. So I've seen contributions for some of my clients that, there might be no purpose restriction, but the donor has specified a length of time that the funds cannot be used for. In one case, that the donor put a 20-year time restriction on the use of those funds. So in that case, that contribution had to be, was required to be maintained in the restricted net assets for that period of 20 years. Also, so organizations have the option with restricted contributions that are released in the same year as received. They can either record those as either contributions without donor restrictions, so previously your unrestricted net assets, or it could be in the contributions with donor restrictions and show the related release. And while the organization can choose which policy they want to adopt, the key here is that they must be consistent in the application of that policy. So you can't choose, you can't kind of pick and choose which way you want to record the contributions. You can't record one contribution one way and then the next contribution the other way. So, just make sure you maintain your documented policy and then apply it consistently. Another area of difficulty with contributions is regarding conditional gifts. And we discussed these earlier, but these contributions, they can't be recognized until the hurdles or the conditions as specified by the donor have been met. But even if you haven't recognized a contribution because of the conditions, still make sure that you're disclosing these to your auditor because they will be required to be disclosed in the financial statements. So make sure that you're still having those discussions with your auditor. The last item I wanted to mention on the contribution revenue is the new accounting guidance. It's going to be effective for fiscal year 19 for our 1231 nonprofit organizations, or fiscal year 2020 for our 630 nonprofits. And this is the clarification standard that came out with respect to recognizing contributions versus exchange transactions. And this will specifically be important to our nonprofit organizations that receive, a combination of both government funding and donor contributions. So the key takeaway is, really in determining whether the transfer of assets is an exchange transaction or a contribution. So this standard really just provides some additional guidance on making that determination because it can be really quite difficult in a lot of circumstances. This guidance also provides some additional guidelines for distinguishing between conditional and unconditional contributions. So I'm not going to go into too much detail on this new pronouncement now, but we do have several other webinars on this topic that you can watch.
So grants to others can be a unique one for organizations. This typically comes up a lot in the conservation space, so either wildlife or land conservation. Typically, we don't have adjustments to this area, but we do have other matter comments or best practice recommendations that come up. So if you're receiving contributions from donors for other organizations and are acting as that grantor organization, it's important to ensure that those grantees and subrecipients that are receiving those funds are not only legitimate organizations, but whether the funds are being utilized as the donor intends. And really this all comes down to just making sure that you're maintaining the proper documentation to support this. So any memorandums of understanding, maybe the tax exempt certifications for those other organizations, documentation for the funds that you've passed, and then if you get any program progress reports or those other organizations' annual financial statements. In the case for grants or grants of lands or easements, making sure that you've retained support for the transfer of the property. So really, document retention and maintaining that support is really the key item here and important for the organization. And then also looking at kind of some other expenses this year with the new nonprofit reporting model, a statement of functional expenses is required. And it's required to report those expenses by natural classifications and functional classifications. Previously, this used to only be by function, so you'd report by program, management in general, or fundraising. So showing the natural classifications is now required, and what we mean by those natural classifications are those line items like salaries, your benefits, occupancy, interest expense, etc. So this has been required for your 990. So a lot of organizations might already be doing this, but it's definitely something that we recommend that you have to start doing sooner. We work with a lot of organizations that have said, we do this, but we don't typically do this until we have to do the 990, so much after the audit's already kind of been finalized. Well, now since it's part of the audit and it's needed for the audit, it's something that, you know, just to keep in mind, you are going to have to start it early. And then some other things to keep in mind as you're preparing the schedule. If you do present any cost of sales on your statement of activities, these costs all now have to be presented in their natural classification as well on your statement of functional expenses. And then you would have to show a reconciliation on the bottom to get back to your statement of activities amount. And then if you do have any investment expenses, so any costs of having those investment accounts managed, those are not presented on your statement of functional expenses. On your statement of activities, they're actually netted against any income from investments in the current year. And then just always a best practice to keep in mind, keep your allocations consistent and make sure you have a basis for those allocations determined. Part of the testing that all your auditors will be doing is making sure if there were any changes, that those changes to the allocations are properly supported. And then you may be asking yourself kind of, you know, why does this all matter? If you follow any watchdog groups, so Charity Navigator is a big one and GuideStar, they pull this information from your 990. So they take all your functional allocations, how much is going to programs, how much is going to management in general and fundraising, and they actually rate each organization based on those percentages. They also calculate like a fundraising efficiency or a cost to raise a dollar. And from a donor's perspective, this information is really important. Donors want to know how an organization is doing and kind of see the impact to the programs that those organizations are serving. And then looking at kind of leases, you know, lease expenses, the new ASU isn't effective yet. And so it's being proposed to actually be delayed by a year. So for now, you'll still follow the same lease criteria. So evaluating whether a lease is classified as an operating or a capital lease. And really the best practice tip that we can give is just making sure that if you do enter into new lease agreements during the year, that you're classifying it correctly. The biggest area where we typically have adjustments for leases relates to the deferred rent. So if you have any leases that have any escalating rent payments or any rent abatements, so if you receive free rent for a certain period of time, that would trigger a deferred rent calculation needing to be done. So GAAP says that you would record rent on a straight line basis over the term of the lease, which differs from the actual cash paid.
And just one thing to note on the deferred rent concept will be going away with the new lease standard. But until the lease standard is adopted, the new lease standard is adopted, you still need to do that deferred rent consideration. And then the only other thing I wanted to mention on the leases, you know, best practice tip is to maintain that future lease runout schedule. You're going to need to disclose those 5-year maturities for the financial statement footnote disclosures. And sometimes that schedule, depending on how many leases you have, it could be, you know, a bit time consuming to prepare. Also, just make sure that listing of leases is complete and all new agreements have been provided to the audit team.
And so Grace kind of mentioned, you know, maintaining that schedule, and I would go a step further and just kind of add in making sure you reconcile that schedule back to your general ledger. Oftentimes we see that lease agreements have some CAM charges, so those common area maintenance expenses that, you know, the total amount that you paid during the year won't be explicitly stated in the lease agreement. So there's oftentimes issues with reconciling back to the expense that you recorded. So just kind of going through that and making sure before you provide everything that you've checked that and everything does tie out.
Okay, the next topic here is with respect to the financial statements and footnotes. With regards to the preparation of financial statements, certainly something you want to discuss with your auditor during the planning phase, significantly far out from the audit, is whether you're going to be preparing the financial statements, or if you want your auditor to assist with that preparation of the financial statements. If you do want your auditor to assist you, you just need to make sure you have a qualified individual to oversee those services being performed. And then another thing to keep in mind, as part of is having complete footnote disclosures and having that support on hand, right? So, concentrations for receivables and revenue, your future lease commitments, investment fair value disclosures, your schedule of conservation land and easements. These are all things that are going to need to be accumulated into those footnote disclosures. So making sure that you have that information on hand so that you're not struggling to put it together as we're trying to prepare those financial statements.
And so another big thing just to kind of point out with your financial statement process and your footnotes, this year with the new nonprofit reporting model, a liquidity footnote is required. Since it is the first year of adoption, if you are presenting comparative financials, you don't have to present for that comparative prior period. But just making sure that you have that information available, you've identified kind of what those assets are that are available to meet cash needs within 1 year. You've identified what those restrictions on those assets would be, and that you've really worked through with your finance committee or your board kind of what the organization's policy for maintaining liquid assets is. I think that's a big one, and going forward, that footnote's going to be there, and it's huge for donors to kind of get an understanding of where the organization actually is in terms of liquidity, since sometimes there could be very big swings year over year depending on the contributions coming in.
And this is, it is a new footnote, so it can be a bit time consuming to prepare. And since it's new, you have, no prior basis. But this is something that you should certainly reach out to your auditors for. There's lots of example disclosures out there that we could provide and, work through you with to develop that disclosure.
And so from the audit side, hopefully we've given you kind of some good tips and some useful things to carry forward to your next audit. We'll kind of pass things over to Melody to walk us through the difference between audit and Tax-PBC requests.
Yeah, thank you, Jessica. So I know everyone who is listening to this webinar right now want to learn how to prepare for your next audit, but why we include tax into the how to prepare for your next audit topic. So that's the reason because recently we found that most of our audit clients would like to have their tax return to be started as soon as the audit report is issued, or even for certain clients, due to their internal board meeting deadline, they would like their tax return to be prepared as soon as the audit trial balance is finalized. So that's the reason the audit team and the tax team would like to coordinate together to help the client to prepare for your audit and tax ready at the same time. So today I would like to explain a few areas between the difference among audit and tax to better help you understand the engagement and also understand like why we request those information, why we ask those questions. So the first is the PBC request, as is known to all. So for both the audit PBC request and the tax PBC request, for all of our clients, we have the sure link set up. So for each year, we have the audit folder and the tax folder include all the PBC requests that are in sure link. So oftentimes I got like question from the client. For example, I already upload this information to audit, why you request the same information to me in tax. So that's the reason I would like to elaborate on this. The two most frequently asked areas are board member list and statement of functional expenses. So the first one, the board member list. So the audit, if they ask for the board member list, they will like a whole Word document to include the full board member for the entire year. However, for the tax, we have a separate non-composite board member list at year end that designed for you. The reason we request this is because Form 990 Part 7, we have to disclose all the non-compensated board member on that page. And from the audit list, we do not know whether the board member is compensated or not. And also on Part 7, of the Form 990, we have to disclose if any status of the board member changed during the year. For example, if any new board member joined the board during the year or left the board, we have to include the date joined or the date left the board. That's also the information that we cannot get from the board member list you provided to audit. So please understand that we do not request the duplicate information. Yeah, that's for the board member list. And the other area is for the statement of functional expenses. So for audit, usually the audit report the like statement of functional expenses when they prep for the statement of activities, and then that on the statement of activities on the audit report, we got a total for each category. So for program, for management, and for fundraising. And for some of the clients, we might have a statement of functional expenses report included in the audit report, but that's not most of the cases. Even if we have the statement of functional expenses report included in the audit report, that is different from what is required by IRS on the Form 990 Part 9. So basically, we design our tax SFE PBC request exactly 100% match the Form 990 Part 9 and reporting line by line. So that's the reason we want to get the primary number from you, and then we will, based on the information you provide, we will make any adjustment if necessary. So please understand that is also different from audit because we have to report different category, different expenses. And the best practice tip here is tax and audit request different PBC based on different reporting requirement, because audit report follows GAAP and tax reporting follows IRS. So that's the reason we have different PBC requests. And the other area is the disclosure requirement. That is a topic in general. So for tax, sometimes during the preparation, we often ask client some very detailed information that the auditors might not ask before. For example, we might ask client, how do you review the tax return? How does the office of compensation get reviewed? And if you have grants out, how do you monitor the grants? And also, do you have any below policies in act in the organization, such as the conflict of interest policy, the whistleblower policy, and if you do accept gift, especially non-cash contribution, do you have a gift acceptance policy in act? And also, we have very detailed disclosure requirement per the IRS for contribution, including cash contribution and non-cash contribution. So cash contribution is going to be disclosed in detail on Schedule B, and non-cash contribution is going to be disclosed detail on Schedule M. So that's the information that will not be included in the audit report, and that's the reason, but it has to be disclosed on the Form 990, and that's the reason we ask. And also, we have something new this year is due to the Tax Cut and Job Act imposed on the employee parking and community benefits starting January 1st, 18. So we never ask about the employee parking and community benefit that provided by you in prior years, but since it's new to you and it's new to us starting from this year, so if you ever get a question like this, please do not be freaked out because it's totally new, and that's something that we need to start looking into for the 2018 tax return. So the best practice tips here is tax will have more disclosure requirement audit due to the nature of the return. And that's the tax part I would like to talk about. Thank you.
Thanks, Melody. So again, hopefully you guys got some good tips and takeaways, and really trying to help you guys, you know, be set up for success and have the most effective and efficient audit as possible.
Following these best practice recommendations make your auditors happy. So
the last kind of thing that we did want to run through is just, you know, what's next, what's on the horizon for everyone. So the new nonprofit reporting model is effective now. Grace mentioned a little earlier the revenue standards that are coming out. So effective 2020, we do have revenue recognition, so 606, and then we do have some clarifications for those grants and contributions. And then looking down the line, 2020 for December clients, 21 for 6/30 year end is our lease accounting standards. The FASB has proposed, you know, delaying issuance of the lease accounting standard for maybe a year, so we'll stay tuned for that one. If there is any, you know, further questions or clarifications on any of these specific ASUs, we do have webinars specific for each one of those. So that is information that we can help you with just to make sure that you're kind of staying ahead of the curve for everything for your organization.
All right, well, thank you so much. Hopefully you learned a few tips and tricks, and thank you for watching our webinar.